So welcome to India Infoline. You have launched a new fund that is Reliance BSE Fund, Junior Fund.
Yes.
So what is the USP of this fund and how this fund is different from other funds?
Okay. So this is the Reliance Junior BeES Fund of Fund. Now it's a passive fund. That means it tracks an index. The index that it tracks is the Nifty Next 50 index. Now if you look at the way indices are defined in India, the top 100 companies, okay, as per SEBI's classification, are all large cap companies, right? Now, the best companies among the top 100, the largest companies, go into the Nifty index, and the next 50, that is 51 to 100, come into the Nifty Next 50. Now, if you look at the Nifty index is the best companies in India. It's like the Ivy League of Indian corporates. Eventually, what happens is a lot of companies from the Nifty Next 50 actually move into the Nifty. So, if you look at history, 41 companies have gone from the Nifty Next 50 into the Nifty, right? And currently, out of those 41 companies, 27 are still there in the index. So you can imagine that more than half of the index have got companies that have come from the Nifty Next 50. So it is like a child going into a primary school and then coming out in secondary school. So it's basically already good large cap companies. But somewhere down the line, all valuation happens over there, and when they become mega large caps, they move into the Nifty, and that's where you can catch the growth of these companies. Now, if you look at the returns of this index, if you look at the returns of the Nifty Next 50 over the last 10-year horizon, it's given nearly 20% return, the index, whereas the Nifty has given about 14% return or so, right? And therefore, it's a very good proposition for investors to invest in, because these are still large cap, good companies, but the potential for them to become larger is very high.
Okay. So I would like to understand what is the difference between active investment, like active funds, and passive funds?
So passive funds basically tracks an index. In an active fund, you are dependent on a fund manager's ability to beat the market. But if you look at data, especially in India now, it's becoming extremely difficult day in and day out. For active fund managers to keep, beating the index. We did a bit of research and we found that there are nearly 45,000 companies in India which is into the business of generating alpha, right? Now, it's these companies and all these people, all these smart intellectual people investing in those same companies that are there in India, and therefore it becomes very difficult for one guy to beat the other guy.
Correct.
Eventually what happens is that the active funds that you're investing in, you end up paying a very high expense ratio per year. So very few investors are aware of the expense ratio that they pay. When you're investing in an active fund, the expense ratio per year is nearly 2.25%. That means 2.25% of your return of your money is getting removed from your investment as charges by the mutual fund, right? Now imagine on a 10-year period, the 2.25% into 10 becomes 22.5% return gone.
Correct.
Over a long period of time, if you're not able to beat the index, then why should you pay so much of an expense ratio? You might as well invest in an index fund, which is charging probably 0.4, 0.5%, which is nearly 2% lesser than a normal active fund. And therefore, it's cheaper, and therefore over a period of 10 years, you're only paying, say, 4% as compared to 22.5% in a normal active fund. And because of which, more of your money is getting invested in the market, and therefore your money is working harder for you.
Correct.
Yeah.
So, as you said, expense ratio is a very important factor. Apart from that, why should an investor invest in ETF and index?
Simply because of the fact that in an index fund is very simple. Okay, at any given point of time, you're investing in the best companies that are there, in your country at that point of time. A lot of people think that index is boring, but remember one thing: an index never goes on leave. Okay, an index never asks for bonuses. An index never falls sick. An index is always working for you all the time. Now, even in the year, say 2000, 50 companies in the index. Today, if you look at 50 companies in the index, they're very different. So an index also changes as per how your economy is. But remember one thing: today I'm investing in the best companies that are there in my country. 20 years down the line, also I'll be investing in the best companies that are there, in the country. Okay, so if you believe in the India growth story, then might as well just invest in the index.
And then how do you see the growth of the active funds? What is your outlook of active?
Well, active funds over a period of time are going to find it extremely challenging to keep beating the market, and therefore a lot of money will move from active towards passive. But what we tell people is that you should build a portfolio, and your portfolio can be something like a core and a satellite. Okay, when I mean core, I mean larger part of your portfolio, and satellite a smaller part of your portfolio. Now, if you believe that in the Indian markets, the possibility of generating alpha, that means higher returns in the index, is not there, then core of your portfolio, maybe 75% of your portfolio should be linked to an index. Okay, and 25% should be in an active fund. Okay, where the possibility of you outbeating might be there, right? But if you believe that there is still a lot of alpha to be generated, in India, then core of your portfolio can be active, and satellite can be passive. So depending on what your belief is, you can kind of build your portfolio in a manner which kind of executes your view.
Okay. So if we talk about ETF industry, how do you see the growth of ETF in Indian market?
So ETF industry, I mean, I don't know how many people are aware, but today the largest scheme in India is the Nifty ETF, right? So ETFs are gaining a lot of popularity. Like in all other countries, okay, ETFs have taken off in India more with institutions than with the retail public, right?
Yeah.
And why is it not taken off with the retail public? Because of the fact that there is no distributor selling an ETF, right?
So there's a need to, make people, give awareness to the people.
Yeah, awareness to the people, but there is no remuneration going from the ETF service provider to any distributor. So the distributor is not getting remunerated by the asset management company, because the asset management company doesn't know who the investor is. So for example, if somebody buys an ETF, he has to go onto the NSE terminal or go to a broker who has an NSE terminal and buy those shares. Now, I don't know who he's bought it from. So there is no way for me to remunerate any kind of distributor. Okay, and therefore no distributor sells an ETF, right? And therefore most ETF, I mean, an ETF basically is a pull product and it's not a push product, right? And therefore on the retail side, it will take time for it to grow. But as people see that active funds are not performing too well and it's becoming very difficult to beat the market, that's when people will start moving towards passive products like an index fund, like the current one, that we have, the Nifty Next 50 fund of fund that we have, and also ETFs that are already there in the market. So people will start investing in these much more, and we've already seen that happening.
So I just wanted to understand what sort of risks are involved in passive funds.
Passive funds have the same risk as what is there in the market. So when you're investing in an equity fund, okay, you are exposed to the normal risks that are there in the market. So the market might fall, market might go up. The only difference being that here you are not taking any fund manager risk or fund manager bias, right? So whatever risk is there in equity investments is the same risk that you're taking in an index fund as well. So if the index goes down 10%, your portfolio will also go down 10%. If the index goes up 10%, then your portfolio will also go up 10%. It's very closely linked to how the index behaves.
Retail investor, if he is going to invest, what kind of portfolio should he choose? He should have active funds also or passive funds also? It depends
on his need. And you asked a very good question. I think it's extremely important that people build the right portfolio. But to build a right portfolio, each person's individual need is very different. So my individual need versus your individual need will probably be very different. My ability to take risk and your ability, to take risk is also very different. So depending on your needs, person should build, a portfolio. Now, if I'm very conservative, then obviously a large portion of my portfolio should be into safer assets like fixed deposits or debt and lesser into equity. But if I'm that person who's willing to take more risk, then obviously more should be into equity and lesser into debt. So that's how each individual has to kind of decide how, what is his risk appetite and what are his needs going ahead.
So overall, how do you see the market in this current scenario?
I think markets will probably, by the looks of it, I mean, obviously we have the largest event that is going to happen, which is elections, and I think that's why markets are a little unstable. But I believe that we should not look at individual events per se. we should look at having a disciplined approach towards building a portfolio and invest for the long term, because that's the only way you'll be able to generate value.
Okay. Thank you so much, sir, for talking to us.
Welcome.